I want to share with you 5 things that Wall Street never told you about buying stocks. The first thing, diversification is really a bunch of BS. We hear that we should have a diversified portfolio and that it will help us reduce a lot of risk. It doesn't reduce risk. All it does is it gives us a lot of distractions. If we are trying to buy a portfolio that has 100 stocks, or maybe not even 100, maybe we're gonna buy 50 stocks, or maybe we want to just buy 20 stocks. For the average person watching this, it's a lot of stocks to manage. I'm not going to know any of those stocks in detail. Most of us are trying to build our wealth. Most of us are working separate full-time jobs. Most of us are not trading the markets full-time. And those of us that are trading the markets full-time, it's still a lot to ask ourselves to have a deep understanding of 20 different companies. That means that we would have researched, and we're researching hundreds or potentially thousands of different companies, focusing in on just the best of the best, and then picking another 20 out of those that we will actively manage. And by actively managing, it may not be that we are trading them every single day or intraday. We may not be trading them every single week, but we will want to have a good knowledge of each of those 20 stocks. Now let's say we've done the research, we know a lot about the individual companies, we know when they are going to report earnings, we know when they are going to release new products. Now let's say that we are analyzing the chart patterns too. Let's say something happens. Let's say something happens in the market and we need to make swift and decisive action. Rather than doing this for a handful of stocks, now all of a sudden we have 20 stocks that we need to go into and actively manage. Are we going to be able to manage all those positions effectively? Will we just dump all those stocks? Will we start cutting them all at the same rate? Maybe it's a buying opportunity for some, and maybe it's a selling opportunity for some of the other ones. Are we going to be able to do that for 20 different stocks as an individual, as somebody that is trying to trade part-time, or even if we are somebody that's made the leap to trading full-time, are we going to be able to do all this by ourselves? The answer is probably no. And even if we could, for many brokers, you're going to be racking up a lot of transaction fees on 20 different positions if we are actively managing them. What I found to be a much better solution, and what has been a better solution for so many of the traders that have been profiled in different books, such as Jack Schwager's Market Wizard series. If you haven't read it yet, definitely pick it up if you have any kind of interest in the market at all. He profiles the best of the best traders in our generation and figures out what makes them tick, how they and why they have been so successful in doing what they were able to do. And one of the things that you'll see is that they have a lot of different perspectives. Some of them will trade one way, somebody will trade the exact opposite way, but a common thread among all of them has been a concentrated portfolio. Not trading 20 or 100 different stocks, but focusing on 5 different stocks, or focusing on, at most, roughly about a dozen to have that kind of concentration, to have that deep knowledge. And if they're focusing on a dozen, well, to even show up in that book, you know that they are professionals, that they are doing this full time. For us, it will be much better for us to know a maximum of about 5 different stocks in very good detail if we are trying to go it alone, maybe even 3. If we do have help, if we are enlisting the help of someone to help see other perspectives, then maybe we could have a little bit more. Then typically with our service, in the advanced stock report service where we're running our model portfolio, we will have up to about 8 stocks as a maximum, and we'll progressively increase the number of holdings that we have, but the most has been 8 as of late. As the market has continued to move on and rally, we will get in and follow along. But it is the concentration in a smaller handful of names versus widely diversifying and trying to mitigate that risk. But meanwhile, we really don't have a good understanding of any of them, and we're actually taking on additional risk because it's that much harder to manage those positions. We have so many additional transaction fees because there's so many different stocks, and then to be able to execute on 20 different trades, it's not going to happen when the bullets are really flying. 5 of them, yeah, we can handle that. 20, not going to happen. The second thing that Wall Street doesn't tell us is that it's actually pretty easy to find stocks that are outperforming. We don't need that kind of diversification. We don't need to necessarily look at a benchmark and try to beat that benchmark. Oh, we beat the S&P 500, yippee! That could be great if you're a mutual fund and you beat the S&P 500, which is the standard benchmark index, by 1% or 2%, you're outperforming, but that's not what we're looking for. If we're looking to actively trade the market, we want to get to a spot where we aren't just making the market average. We want to be doubling, we want to be tripling the market average. That's what we've been able to routinely do. The way that you're able to beat the market is by finding leading stocks. And finding leading stocks, it's actually not that hard. The way that you're able to find leading stocks is by simply looking at which stocks are leading. What does that mean? So stocks that are consistently hitting their 52-week high, you keep those on a separate watch list. And then not everything goes up forever. Nothing goes up in a straight line forever. That's not the way that the market works. It will go up and then it'll start to consolidate a little bit. When it starts to consolidate, then you are ready to pounce. It's been on your watch list, you've been monitoring it, you've been monitoring this smaller group of stocks, and you're ready to go. That is how you find leading stocks, and that's how you capitalize on leading stocks. It's not something that Wall Street typically tells us how to do. The third thing that Wall Street typically doesn't tell us is that the market environment matters a lot. I remember when my first real taste of the market, it was back in '99, and I had saved up a little bit of money at the time working part-time. I think I had about $5,000 at the time, and I walked into my local bank and I told them that I wanted to buy some stocks, and they told me, you don't want to buy stocks. Stocks are way too risky. What you want is this. And they showed me what turned out to be a basket of mutual funds. And so I started looking through some of the prospectuses of them, and they're like, what are you doing? Nobody reads those. You don't want to read those. And then I'm like, okay, being 19 at the time, I just flipped through it a little bit faster, and then I said, okay, I'll go with this one, this one, and this one. And I picked a couple of growth funds and a bond fund. And I thought, oh, wow, I'm being smart, I'm being diversified, and I have professionals managing this account for me. And so I went off and I started my undergraduate program, and after about 6 months I checked in and my account was up maybe about 6%, and I thought, wow, I'm a genius, right? Here I am, I could have had that $5,000 just sitting in a bank account earning 1% a year, and within about 6 months I was already up about 6%. Man, this is going to be great. And then, of course, my undergrad studies got to be a little bit more intense, and I neglected looking at the market, but I had all these professionals managing it for me. I was very well diversified, and that's it. That's all I needed. So graduation day comes. It's about 3.5, 4 years later, and I want to go out and I want to buy this brand new Jeep Wrangler. Had my eye on it, thought that at the time I would have had a nice size down payment ready to buy this Jeep. And what happened? I go to my account and I didn't have nice down payment. I didn't have $10,000. Didn't have $8,000. Didn't have $7,000. I didn't even have the $5,000 that I initially put in the account. I was down to $4,000. And 4 years had already passed. And I had less money in it than what I started. And I was diversified. I had professionals managing it for me. What in the hell happened? What happened was that the market environment matters so much. And yet, this isn't something that Wall Street tells you about. Wall Street doesn't tell you about trends, doesn't tell you about selling and moving to cash. They want you to stay in their fund. It's not something that's going to help out you or me. That's something that's going to help out them. What we need to do is take charge. We need to understand that the actual market environment matters so much for all the stocks. If 3 out of 4 stocks are going to follow the overall path of the market and then the market tops and starts to tank like it did back in 2000, you're not going to end up with continuous gains. You're going to end up with less than what you started 4 years later, and that's a pretty painful pill to swallow. We don't need to swallow that pill. I've already swallowed it for us. What we need to do is understand that the market environment matters, and we need to pay attention, and we need to understand how to analyze the market. Here's the 4th thing that Wall Street doesn't tell you about. They don't tell you to buy the bounce after the dip. Sometimes we'll hear, oh, you should buy the dip, right? How many times have we turned on the news, turned on CNBC, NBC, Fox, whatever you watch, and there's some talking head on there that's saying, oh, the market's pulling back, time to buy the dip. How do you know if you are buying the dip that's going to continue rallying or if you're buying the dip that's getting ready to fall off the cliff? The answer is you don't. So what's a better solution? The better solution that I've learned and that my buddy Adam Sarhan loves to talk about is buying the bounce after the dip. Right? So if we're looking at a stock chart and we see that this stock or this index or whatever it is that we're looking to trade, we're seeing that it dipped and that it's starting to consolidate and it's starting to consolidate around this floor, then we'll look at, okay, where is that ceiling and where is that floor located, and are they getting tighter? And then if it does bounce and it bounces through this floor, then that is going to be when we look to buy. We don't want to just buy the dip because it could fall straight through, but if it bounces, then that is the opportunity. And then where it bounced, that's going to be our new floor. And the 5th thing that Wall Street never talks about, but is absolutely crucial to our success in the stock market, is that cutting losses is essential to long-term success in the market. My experience, when I was with those mutual funds, they weren't cutting losses. In the first 6 months, I was up 6%. Didn't check it, but at some point, I was probably up about 10% or maybe even 20% in that portfolio, the way that the market was going. And then 4 years later, I was down to 4,000, right? So probably had about a 50% drawdown at some point. For my initial investment, I had a 20% drawdown. What point do we call it quits? They weren't going to call it quits at all. They were just going to stay the course and keep on letting it fall. And that should be unacceptable. We can do a lot better. And one of the ways that we do better is by cutting losses extremely quickly. The way that we can really win in the stock market, the way that we are ultimately going to win in the stock market, is through compounding. We compound our winners. Now, if we don't cut our losers quickly, it's going to be that much harder for us to compound our winners. When we have these large losses, it makes it progressively harder to get back to even and start to progress higher. If we have a 10% loss, it'll take us about 11% to get back to even, but it works exponentially against us. If we have a 50% loss, it's going to take us 100% just to get back to even. That might be okay for these mutual funds that don't really care about us, but it's not good enough for you and it's not good enough for me. What we need to do is cut our losses very quickly. We need to understand where we're going to get out of a trade before we even get into the trade. That needs to be part of our plan. Whenever we are looking at a stock and we like the stock, we want to buy this, we need to plan, okay, where are we going to get into this stock? Where are we going to get out of it if it's wrong? Where are we going to begin to take some profits? Well, what kind of rules, what kind of signals are we going to have? And what kind of other risk management are we going to employ? How large of a position, how many shares do we want to buy? We need to figure out all this stuff. These are things that Wall Street, fortunately, doesn't really talk about, but we're able to talk about it here and we're able to profit together. So those were 5 things that Wall Street never really talks about. Let me know if there was a 6, 7, 8, 9, or 10 that you know that Wall Street never heard of either and doesn't talk about. I think it would be really interesting to hear about those things. If you have any questions, leave those down in the comment section below. I'd love to jump in and help you out. Thanks again for watching. I really, really appreciate it. If you like the video, click that thumbs up button. That's going to help us out a lot. And make sure that you subscribe to the channel so that way you get every single update. Thanks again for watching, and I'll see you again in the next video. Take care and have a great day.